All right, the next question I have is from Nidhin. Nidhin. I'm sorry if I butchered that name. I hope I pronounced the name right. Okay, this is a long one, so I'm going to summarize it. I am 32 years old and have around $50,000 in my retirement accounts. I am married, but my spouse is still overseas waiting for her visa. I make $130,000 and 30% of base as variable commissions in a year. I also have a side hustle that brings in $1,800 to $2,000 a month. Great. I have $30,000 in emergency fund and taxable investment accounts around $8,000. The only debt I have is auto loan, which is $6,000. I am currently renting and planning to buy a home. It's a new build and costs around $483,000. I have saved 10% for my down payment. Will it be a wise move to move forward with the home at that price? I can get other homes, but market is very hot and can't find anything at that location. Location is in Dallas, Texas, and I'm planning to achieve FIRE in the next 10 to 15 years. Okay, so let me pull up the FIRE checklist here real quick, and let's see how you're doing so far. Your income is really high at about $150,000 to $180,000 a year with your side hustle and commission, so that's awesome. You have a fully funded emergency fund at $30,000. You have about $50,000 in your 401k and IRA. You do have a car loan at $6,000, and I'm not sure why you're holding on to that debt when your assets are far exceeding your total liabilities. So if I were you, I would clear the car loan before proceeding to buy a house. You also mentioned that you have several sinking funds for your other financial goals. I would encourage you to create a sinking fund for your initial housing expenses. You want to have some cash set aside for home improvement and furniture. Depending on the size of the house, it could cost thousands of dollars to furnish your new house, so I want you to keep that in mind. There's also a good chance that something will break in the house within a few months you move in, or you find something that needs to be fixed right away. So having a $30,000 in emergency fund will help you prepare for the unexpected expenses. Another thing to get ready for is the closing costs and when the house is done. I don't know the details of the house you're looking to build, but it could be anywhere between 2 and 6% of the home sale price. So just for the sake of this conversation, let's go with 2% of your home price at $483,000 or $9,660 for the closing costs, if not more. I would talk with the lender to negotiate for lower fees and find out what the estimated closing costs will be. So you need to save for the closing costs in addition to your down payment fund. If your lender lets you roll your closing costs into your mortgage, and keep in mind that not all lenders will allow you to do that, so then you'll need to pay interest on the closing costs over the life of your loan. By the way, if you need help with your personal finances, you can schedule a free one-on-one 20-minute financial coaching session by visiting firesidechat.com/coaching. Now, let's look at the current mortgage rate. Assuming your credit score is above 740, the average 30-year fixed mortgage rate is about 4.3% right now, and your mortgage payment for $450,000 just between principal and interest will be around $2,200 a month, and that's not including your property taxes, homeowners insurance, and the private mortgage insurance, or PMI, because you only have 10% of down payment for your house. Your PMI could depend on the loan amount and your credit score, and as a general rule, PMI expenses are a lot higher for larger mortgages. Your PMI will also depend on your loan to value ratio. You want to divide the loan amount by the property value. If it's 80% or lower, then your PMI is 0%, which means you don't have to pay PMI. If it's higher than 80%, then you got to pay the PMI premium. Let's assume your loan amount is $450,000 after the 10% deposit, and your house is valued at $500,000. Then your LTV rate is 90%. Your PMI rates could be anywhere between 0.5% to 2%. It's going to give you the total PMI amount you'll pay until you reach 20% equity. With $450,000 in mortgage loan at 0.5% PMI, it could be extra, let me do the math real quick, it'll be like about $190 a month, or if it's at 2%, then it could be extra $750 a month, and that would be insanely high, right, if it's at 2%. So you need to decide if having the PMI is going to be worth it, or if it's going to create an unnecessary cost to your total housing payment. With the income that you have, I would wait until you have 20% or more in down payment. Texas has one of the highest property tax rates in the country, and please correct me if I'm wrong, but I don't think it's the state of Texas who taxes you, but it's based on the county that you live in. So I did a video on the top locations to retire, and I remember the average property tax rate in Texas was around 1.8%. So I don't know if you're going to be in the Dallas area, but I would find out what the property tax rate is going to be. If your home is valued at $500,000 and the property tax rate is at 1.8%, then your property tax will be around $9,000 a year or $750 a month. Your property tax and homeowner's insurance will most likely be paid out of your escrow account with the lender. So let's break it down. Your mortgage loan at $450,000 with 4.3% interest rate will require you to pay, we'll just say $2,200 a month in principal and interest for a 30-year fixed rate. And let's assume you have an excellent credit score, okay? And your PMI is 0.5% of your loan, and that's about $190 a month. Your property tax in the Dallas area, we'll just say 1.8%, will cost you $750 a month. Your homeowner's insurance will estimate it at, we'll just say $100 a month. Your total payment to your lender could be about $3,200 or $3,300 a month. Keep in mind that this is all estimated, and I'm not including any HOA or any other fees that Nidhin may have. Is it wise for you to pay for that house? Let's see if it makes sense to pay $3,300 a month based on your income. Your gross income is about $180,000 or $190,000 a year. So I'm gonna guess that your take-home income is about $140,000 a year or $12,000 a month. And your mortgage payment alone with the PMI would put you in about 27% or 27.5% of your take-home income. In my personal opinion, I think that's a little too high. Can you afford it? Sure. However, your cash flow might be reduced due to the PMI and lower down payment. A new house is almost always more expensive than an existing house. Having a new home is always nicer than an existing home. I've had a new home before, and you have the ability to choose the finishes and fixtures that you want. You could probably choose the latest energy efficient heating, ventilation, cooling, and home appliances. It also comes with a builder's warranty that can cover structures, systems, and any finishes. However, there are cases when the material prices go up when the home is under construction. And last year, building materials prices have increased 12% year over year. Lumber prices have almost tripled in January 2022. We're still experiencing high inflation that will force home builders to raise prices on building materials. I wouldn't count on the home builder prices to fall anytime soon with the rising labor costs and longer than expected supply chain shortages. Building an existing home could be cheaper because the home is already there and you don't have to worry about the builders and materials. You can also see how the existing home has appreciated in value over the years. With the new home, you don't know if you're buying at an all-time high or at an all-time low. Buying an existing home doesn't guarantee a good long-term investment, but you can still make an educated decision based on its historical value. The downside of buying an old house is the maintenance cost, and you could have an aging plumbing system, broken floors, and older appliances, right? And you might have higher utility costs because older homes don't always come with energy efficient heating, ventilation, or cooling systems. The bottom line is you need to decide if it makes sense to spend 27% of your take-home income on housing expenses. People like us on the FIRE journey would prefer to keep the housing expenses below 20% if it's at all possible, so we could save more money towards early retirement and have more fun money for us to enjoy. As mortgage rates continue to rise, my prediction is that the home prices will decrease throughout the year as demand decreases. The supply chain shortages won't last forever, but the wages will probably continue to go up. So we're being very patient with buying our next home. Personally, I will wait to buy a new home until I have saved at least 20% of down payment to avoid PMI and keep the housing expenses below the threshold. I would be entirely fine with paying rent for another year because I wouldn't want this house to lower my savings rate. One last thing, I would wait until your spouse gets the visa to move to Dallas and then buy a house. Now, I'm sure your spouse will want to have inputs on the finishes, furniture, and location of the new home that you guys are looking to build. I know my wife would.